Hey, good day, everyone. Welcome to the Bert Salazar Retirement Show. My name is Bert Salazar, and as always, I'm here to kind of discuss retirement and tax planning and retirement distribution and many, many different items that are so critical for all of us that live in the United States of America. Now, today's a big day because today is midterm elections here in the United States in 2022. So I'm hoping that all of you are excited to go out and vote and make sure you exercise that right because there are so many countries in the world and so many millions of people throughout the world that don't have that ability to go out and vote. That is so important that we take advantage of that on an ongoing basis, whether it's a presidential election or whether it happens to be a local election and also obviously the midterm. So it's an exciting day, depending on which side of the aisle you find yourself in. And we'll talk a little bit about that as well. It may be very exciting to you or it may be very sad, but at the end of the day, the title for this episode, this is episode 184. So as you know, we've been doing this now for quite some time, and the title for the episode is "The Politics of Economics," and it's apropos because it's a perfect day for this. So I want to share some things that are very, very important that many years ago I didn't think through, but over the last 10 to 15 years, I've been giving it a lot of thought. So every time I go to the ballot box to cast my vote, I pay attention to a lot of the stuff that's going on, not only in the economy from an internal standpoint, but also in the economy from an external perspective. And that's something very important for all of us to take a look at. Now, I think it's very important if you want to make the right decision at the right time and for the right reasons when it comes to voting, that you need to be able to merge politics and economics together. Because at the end of the day, you know, all of us listen to that famous radio station, WIFM, which is what's in it for me. So if one party is going in a different direction that you want to go, then it's important that you vote that party out of power if you want to succeed in your personal and financial life. Now, all parties are guilty of doing many a times the same things. Some may do it a little bit more than others, but at the end of the day, I am not here to preach which party you need to belong to or what kind of vote you should be casting. That's obviously between you and your family, and actually between you and yourself, no one else. What I'm here to do is I'm going to share some ideas that you need to consider before you go out and vote. I always tell my clients, make sure that if you're going to vote, do it with your brains and not with your ass. And I mean that literally because I've seen it many a times where you have people that either they're so radical or they have been brainwashed to such an extent that even common sense decisions are very difficult for them to handle and to do it. Now, at the end of the day, you know, one of the things that I've noticed after doing this for 35 years is that, you know, even a broken clock is right twice a day. And this is what I say, not only from an economic standpoint, but also from a political standpoint as well. I would also argue that the vast majority of Americans today in the United States are suffering from stage 4 financial cancer. And that may apply to a lot of you watching this podcast or watching this video as I'm doing today for all of you. So what I'm trying to do now, what I will do for the rest of the time that we're going to spend on this podcast is to kind of help you minimize a lot of those liabilities and how to reduce, you know, from stage 4 perhaps to stage 3, 2, 1, or even get rid of that financial cancer all along. You know, many years ago, I started to watch golf, and not because I ever played golf, because I've never played golf, but I really enjoyed watching Tiger Woods. Tiger Woods, to me, and again, I've seen Jack Nicklaus and many other great golfers, but Tiger Woods took the game to a different level altogether. Now, obviously, I would say, the last 8 to 10 years, he's been suffering tremendously from, injuries and surgeries and all kinds of stuff. So obviously, Tiger Woods today is not the Tiger Woods of old. But if I, from a financial standpoint, because I love to do analogies, if I would have said to you, look, I'm going to give you the opportunity to win a big tournament. And if you want to go play at the Masters and you have the ability to qualify to go to the Masters, and before you start playing at the Masters, you have someone that comes to you and says, okay, John, listen, I'm going to give you an option. And if I give you this option, you may actually increase your probabilities of winning the Masters. I'm going to give you the option to either use Tiger Woods clubs or to use Tiger Woods swing. Which one of the two would you pick? Now, and the reason why I say that from a financial standpoint is that the vast majority of clients that I engage for the first time, for many, many years prior to that, they had been choosing the clubs instead of the swing. So although clubs are very important, and I use the clubs all the time, especially when it comes to doing our TRB program, our Tactical Retirement Blueprint, we do have to choose products, and those are the golf clubs in finance. But the swing and the platform, the characteristics of what you're doing with those clubs is most important. So if I had a choice, I would definitely 100% of the time, I am going to choose Tiger Woods swing as opposed to his clubs. So from a financial perspective, you ought to be thinking along the same lines. And this also applies, to how you choose the leaders that you're going to be voting for when it comes to voting time and voting decision as we're going through today in the United States. Now, another point that is very important for all of us is that, we take a look at our retirement plan and you take a look at your statements. You get your statements either on a monthly basis. Some of you may get it quarterly, some of you semi-annually, some of you annually. But at the end of the day, you take a look at your retirement plan and your retirement assets and all of the money and the stuff that you own. You look at it through a money lens. In other words, I have 200,000, I have 500,000, I got 1 million, I got 10 million, whatever the number may be. Now, what I would encourage each and every one of you to do is that instead of viewing your money through a mathematical perspective, view it as a value perspective. So instead of saying, look, I'm going to be retiring in 10 years, I have, $750,000 in my retirement account. Instead of looking at it that way, consider the following. What can those $750,000 that you have in your retirement account do for you? What can it buy you at this point in time? And that's when we're going to start talking a little bit about inflation and so forth. So at the end of the day, my recommendation for all of you is that stop looking at the numbers and pay attention what it is that those numbers can buy for you, because at the end of the day, retirement is all about cash flow. I would argue that if you had a guaranteed pension until the day you died, you probably wouldn't save any money, or if you did, you would save very little. Why? Because the reason why most of us are putting money away for retirement is what I call delayed expenditures, meaning you're avoiding spending the money today so you can spend it at some point in time in the future. But if you had a guaranteed pension, and if you're married, and if your spouse also had a guaranteed pension, chances are you wouldn't be saving a lot of money because you couldn't care to save for the future because of the fact that you had a guaranteed pension. Now, this is applicable for the vast majority of Americans. There are always exceptions to every rule, but that's the way we look at it from that perspective. Now, the reason why I ask you to look at the value of the asset and what can and the assets that you have for retirement, what they can purchase for you, is because let me give you an analogy. If you take, first of all, money is not math. So if you try to equate money with math, like I have $50,000 set aside for my retirement goals. That is math. That has nothing to do with money because money works totally different than math. So let me give you an example. If you have, let's say, 20 pounds of gold and you go to the bank and you open a safe deposit box and you put the gold there, and you come back a year later, you're going to have 20 pounds of gold. If you come back 10 years later, you're still going to have 20 pounds of gold. And if you come back 20 years later, you're still going to have 20 pounds of gold. Now, the value of the gold may fluctuate, but you will have 20 pounds of gold in that safe deposit box. But what if instead of gold, you have 20 pounds of oranges or apples? See, when you come back a year later, all those apples and all those oranges are going to be rotten. So you're going to have, I mean, it's going to smell pretty bad. You're still going to have the remnants of what they look like at some point in time, a year from now. But what if you come back 10 years from now? Obviously, germs are going to start eating at all the apples and all the oranges, and there's going to be very little left, if any. And I know that in 20 years, there's not going to be anything there. And you'll never be able to know that you had already placed, at some point in time in the past, 20 pounds of oranges or 20 pounds of apple. Now, money works the same way because money gets eaten away by a number of things: taxes, inflation, loss opportunity cost, fees, stock market volatility, interest rate volatilities. So there are a lot of things that are attacking your money every single day. And if you don't pay attention to that, and if you don't start to make decisions, especially when you're dealing with politics, and you start to bring the economics aspects of it inside your politics, chances are, instead of having gold in your safe deposit box, you're either going to have rotten apples or rotten oranges. And the decision is yours. It's nobody else's from that perspective. So that's a good point for all of us to consider, especially as you start to take a look at, who's doing what party is going to hurt you the most from an economic standpoint, what party is going to help you the most, and then you start making those decisions along those lines. Now, we all take a look at taxes all throughout the world, and I've visited many, many countries in the world, especially in Europe. And I always hear that taxes are very high everywhere else and also in the United States. And whenever I ask someone, well, what kind of taxes do you pay? First thing is, well, Bert, we pay federal income taxes and, I'm in the 20% tax bracket. And I said, well, but is that all the taxes that you pay? And you'll be surprised how many people that, unless they live in a state that also you have state income tax, and they may say, well, I pay federal, I pay state, I may pay city if I live in New York or Massachusetts, or if I live in Connecticut. Also, if I live in California, there are many states that will also charge you a state income tax. But most Americans have no idea how many taxes they actually pay, because everybody just thinks about, your federal income taxes. So I have a laundry list. I'm not going to go through all of them, but I'm going to give you a laundry list for all of you to really start thinking about taxes. And most important, you ought to be thinking about where taxes are going to be in the future. And I'm going to give you a little bit of information on about that in the next few minutes. So what are the taxes that Americans are paying today? And this is just a laundry list of things that I'm going to go through very quickly so you can take a look at. Obviously, you have your federal income taxes. You have your Social Security tax. You have your Medicare tax. You have your state income tax if you happen to live in a state that charges state income taxes. You have property taxes, personal property taxes, school tax, long-term capital gains tax, short-term capital gains tax, sales tax, gasoline tax, that's a big one, water and sewer tax, tax on energy, gas, electricity, heating oil, business tax if you happen to own a business, cable TV tax. Take a look at your cable bill every year. And by the way, the government is very sneaky because many times they're charging you a tax, but they call it something else. They may call it a fee or a usury fee. At the end of the day, it's all a tax because it's a punitive charge in your pocket and in your personal economy. Use the taxes: unemployment tax, Medicare surcharge tax, workers' compensation tax, airport tax. Next time you buy a ticket to fly from point A to point B, take a look at all the fees and taxes that you pay for that ticket. Telephone tax, cigarette tax if you smoke, corporate income tax. Well, even if you don't smoke, you're still going to have to pay that tax. Accounts receivable tax, inventory tax, marriage license tax, liquor tax. During the pandemic, they made liquor stores an essential part of the business, so they stayed open during the pandemic. They cleaned house. They did extremely well because nobody could do anything other than go into a liquor store, buy some liquor, and bring it home. So that's interesting. Food license tax, hunting license, road usage. I mean, there are dozens and dozens of taxes that Americans are paying every single day. Now, what I always say is that inflation is theft. And the same as taxes. Robert Breedlove, which is someone that I follow, he's a very bright young man, and he talks about, money, the value of money, what money is, and talks about economics. He's heavily involved in crypto, especially Bitcoin. And Robert Breedlove says something that is very interesting. He says that if you pay zero taxes, you're totally free as a human being. If you pay 100% in taxes, you're a slave. So the question is, where are you going to take your poison? Do you want to be a free man or a free person or a free woman, or you want to be a slave? Now, the further and the closer you move to slavery, the closer you are to that slavery that is killing you and your family. So taxes and inflation is theft. I mean, most of the time inflation is created by the government because inflation is nothing more, nothing less than increasing the money supply. There's something called an M1 and an M2. That's the increase in value in the money supply. Just in the last couple of years, the money supply has increased by 40%. Now, what does that do to the money that you have in your retirement accounts? What does that do to the money that you have in your savings accounts, in your investment accounts? The more money is the more the money is printed by the U.S. government, especially the Treasury, the less value your money have. So that $750,000 that you had set aside for retirement may now only be able to buy $500,000 worth of goods and services, and in another 5 years, maybe just 400 or 375 or 350. And if you go 10, 15, 20 years, it's almost an impossibility for you to save enough money in that retirement account to provide for a viable retirement benefit to you and your family, unless you do something about inflation and unless you do something about taxation. Now, something interesting about taxation, you know that right now we're living under the TCJA, which is the Tax Cuts and Jobs Act that was signed into law by President Trump back in 2017. Now, that has a sunset provision. That means that on January 31st, 2025, that sunset provision is going to kick in. So what does that mean to you and I? Well, that means that when we all wake up January 1 of 2026, taxes are going to be much higher than they are today. So when I ask people, do you think that taxes in the future, based on all the debt and liabilities that we have in this country, do you think that they're going to be uh, the same, lower, or higher? 99.9% of my clients are always telling me that they're going to be a lot higher in the future than they are today. So if they're going to be higher in the future than they are today, and we know that the future is right around the corner because it will be January 1 of 2026, unless we elect a Republican president in 2024, and he or she may want to, move that law down the line. But you got to start planning now. You got to start saying, okay, how am I going to protect myself and my family from the nemesis of taxation and inflation moving into the future? So what I would start doing today, start putting your money into retirement accounts that where you're paying the tax today at the lowest rate, and now you're going to live a tax-free life for the rest of your life. And those are things that I can help you with, but today is not the conversation for that. So start thinking about which party, which political party loves raising taxes as opposed to not raising taxes. And by the way, all parties have raised taxes at some point in time in the past as well. So I'm not saying that you need to vote for one or the other, but you got to be smart and you got to take a look at what's going on, because you have to have the ability to make a paradigm shift in order to understand the fallacies of economics and politics when it comes to your decision making process. Now, there are three types of economic measures when it comes to inflation that I like to maybe spend a couple of minutes with you. Now, we all know inflation. We've been talking about inflation. We're actually at a 41-year high. Inflation in the United States were 8.3 if you look at the traditional CPI, but if you narrow that to the essential products and services that you and I and our families purchase every day, that inflation is not 8.3%, is closer to the 13.5 to 15%. Just try to put gas, try to buy groceries, oil, heating, all of these things are going through the roof. So it's not 8.25%, is the closer to 13.5 to 15% from that perspective. So what is inflation? Now, there are many definitions of inflation that you can find in the marketplace, but the one that is most apropos is the one that says, when you have too much money chasing after too few goods. So any time that the Treasury is printing money, look at all the trillions of dollars that have been printed in the last couple of years. The more money that goes into an economy, that forces the products and services that are sold in that economy to raise in cost because of the fact that there's too much money chasing too few goods. So the government plays an integral part in deciding the levels of inflation. Don't let anyone tell you that we are in a global inflation. Yeah, the entire world is on a global inflation, but who created that global inflation? Nothing more, nothing less than governments that went crazy printing money just to satisfy all of the different groups that they wanted to take care of, and all the stuff that they wanted to do during this pandemic that we have just gone through, because you very seldom hear about the pandemic anymore, especially toward the end in November of 2022. So inflation, once again, nothing more, nothing less than too much money chasing after too few goods. Now, the other side of the coin is called deflation. And deflation is just as bad as inflation, because deflation is that prices happen to be up here, but the people think that prices are going to be here at some point in time in the future. That some point in time in the future could be 30 days, could be 90 days, could be 180 days. Usually within 180 days, So what happens is that gap, nobody wants to pay the price for that. So instead of spending money today, what Americans have a tendency to do is they hang on to their money in hopes that that price fluctuation is going to decrease to a point where they feel that it will be comfortable for them to come in and purchase goods and services. And that's bad because the economy stops completely. So all of a sudden, you have all this money on the sidelines waiting for something to happen. And that is called deflation. And that's really, really bad as well. And then the last one that I want to touch bases with you is called shrinkflation. Now, you probably have never heard of this one. So we have inflation, we have deflation, and shrinkflation. Shrinkflation is similar to inflation, but instead of increasing the prices of the products and services, we're actually reducing the volume of those products and services that we're purchasing, but we're paying the same price. So if you go to McDonald's and you want to buy a hamburger, the hamburger, you're going to pay the same price that you were paying before, but the hamburger may be 10 to 15% smaller than the old hamburger that you used to eat. Or if you go to the grocery store and you're going to buy a can of tuna, notice that you may have 1 or 2 ounces less than what you used to pay before, although you're still paying the same price. So that is an inflationary process in which you are now still paying the same price, but for less. So in reality, if you want to keep the standard of living for yourself and your family, you have to buy more of the same in order to have the same number of ounces in that can of tuna fish that you were able to purchase prior to the shrinkflation. So always remember, keep an eye on that. So you have inflation, you have deflation, and then you have shrinkflation. And yes, sometimes there's nothing that you can do, but also you got to look internally into your personal economy and see how you may be able to mitigate those items along those lines. Another thing that I think it would be important to talk is that always try to maximize your pension benefits. I know many of you are putting money away in your IRAs and your 401ks and so forth, but there's a difference between a pension and a 401k. And the answer is simple: who has a liability? See, if you have a pension and you work for an employer that provides you a pension, the employer is the one with the liability, because when you retire, that pension has to give you an income for the rest of your life. And on a 401k, it's totally different because you're the one that carries the liability. Because whatever the number is going to be at the time that you're going to retire, whether that number is going to be sufficient for you to maintain your standard of living for the rest of your life, that is your problem. It's not the company's problem that you work for. So the question that you need to ask yourself is, if pensions are so good for me, because it will shift the liability from myself and my family to someone else, but you work in a company that does not provide a pension, how can you create yourself, what I call a self-pension plan, that you can maximize and have a guarantee for life that you cannot outlive? Once again, that's another conversation, but I'm just giving you ideas of how to start planning for your retirement distribution, especially for your retirement life, because no one knows how long you're going to live. You don't know whether you're going to go through the go-go years, the slow-go years, and the no-go years. So you're going to spend 30 years in retirement, or you're only going to spend 15 years in retirement. So you have to kind of do the math and do the calculations for the longest as opposed to the shortest from that perspective. We're actually, as you know, we are in a historic high debt, and historically we have low taxes, because over the last 60 years, the average tax rate in the United States has been 62%. And we're nowhere near that. So we have the highest debt that we have ever had in the history of our country. And this is primarily for you, those of you that think that somewhere, somehow, taxes are going to be lower in the future. If we have now in the US the highest debt that we've ever had, over $31 trillion in our national debt, over $185 trillion in our unfunded liabilities. These are the promises that the US government has made to all of us that they don't have the money to keep at this point in time. Take a look at Medicare and Social Security as two of those big ones. So if we have the highest taxes, the highest cost and the highest debt that we've ever had in our country, and we are now pretty much in one of the lowest tax breaks in history, how do you think the government is going to fix this? Do you think they're going to leave taxes where they're at today? Do you think they're going to even lower taxes? No, they're going to be raising taxes through the roof. So you have a very short window of opportunity, which is up until December 31st of 2025, before taxes are higher, and they could even get higher, much higher after that. So that's something that I caution each and every one of you to consider as you take a look at that. Now, there are a couple of tools I want to kind of talk a little bit about. Is that there are many retirement tools that you can use in order to minimize inflation, obviously minimize your tax liability, and there are a number of them. But if I were to ask you, look, what do you think is better, a hammer or a screwdriver? Now, I know all of you are going to say, well, Bert, it depends. It depends whether I need to hammer down a nail or if I need to screw a screw. So when somebody comes to me and says, Bert, what's better, this or that? My answer is always the same. Well, it depends. Well, for instance, if you're looking at what's happening in this country politically, if you're looking at all the money that is being spent, if you look at what is happening to the United States of America from an economic standpoint, you have a due diligence, you have a responsibility to take care of yourself and your family, not only when you go to vote, but also when you start making financial decisions on your personal economy. So what are those financial decisions that you can make? Well, number one, if I can eliminate taxes from my retirement accounts, that's a win-win, because I'd rather pay the tax today where taxes are fairly low in comparison to past tax rates and what the future may bring. So at least if I can pay the tax today, I don't have to worry about any tax increases on those assets in the future. And by the same token, if I can create accounts in which my principal is always protected, and I don't have to worry about stock market volatility and interest rate volatility, which is often created by monetary policies by the US government and also by inflation, then at least you're 3, 4, 5 steps ahead of everyone who's competing for the same benefits and for the same dollars. But you have to be smart. Now, if the market drops 20%, as it did this year, wouldn't that be a good time for you to take some of your IRA accounts or your 401ks and convert them to either a Roth 401k or a Roth IRA or a 7702 plan, which is a cash value life insurance plans where the monies are going to grow tax-free for the rest of your life? Absolutely. Because I'd rather pay taxes on a smaller amount where the market really hit me hard and now my assets are reduced by 20%. Because if I pay the taxes, let's say that I have $100,000 in a 401k and the market just took away, the volatility of the market just took away 20%. So I have 80,000 left. Well, if I take those 80,000 and now I convert them to a Roth IRA, I'm going to have to pay taxes on that $80,000, which you would have had to pay taxes anyways at some point in time in the future. So now the question for you is, do I pay taxes at the lower rate on that $80,000, or do I pay taxes at some unknown rate 5, 10, 15, 20 years from now? So you have to be smart on that. So now your account value is at 80,000 minus the taxes. If you pay the tax out of money outside of that retirement account, even better. But now that 80,000, the market returns, and now you get a positive return. The 80,000 goes back to 100. Now you have a $20,000 buffer there in your account that is totally tax-free. Now you have already paid taxes on the 80,000, so that's not going to pay another tax dollar for the rest of your life. And as that account grows from 100 to 200 to 300 to $500,000, all that growth is going to be totally tax-free. Wouldn't that put you in a much better position than you are today, hoping, because hope is not a financial instrument. Hope is not going to get you anywhere but in a lot of trouble. And now you're taking control of your finances by eliminating taxes out of the equation. And if you place those assets in accounts where your principal is always protected, then now you don't have to worry about those liabilities that the government is going to create with you by stock market volatility, which many times is created by government decisions that are being made every single day in our country. What else? What else? Also, regarding taxes, and this is something that I'm getting now to the end of the podcast, that I think is important for all of you to consider. If it comes to earning an interest rate on your money, would you rather have compound interest or simple interest? Now, you don't have to be a mathematician to know that the more that your money compounds, the faster it's going to grow. So I would take compound interest any day of the week. I don't want simple interest because I want my money to compound faster. But what if I were to ask you, would you rather have compound tax or simple tax? Well, you would probably say, well, right off the bat, I want no tax, and that should be the right answer. But if you have a choice between compound tax and simple tax, which one of the two would you choose? And the right answer is obviously simple tax. The problem is that unless you know how to create a tactical retirement blueprint for yourself, which I know you don't, chances are your assets are going to compound, but so will your taxes. And what you can accomplish via a tactical retirement blueprint is to have the ability to have the best of both worlds, have compound growth or compound interest and simple tax to no tax at all. Now that leveraging between one and the other is going to give you a tremendous ability to grow your assets to a way that you could have never done possibly at any point in time in the past. And then, a couple of things that I want to share just before I close is that, Warren Buffett said that if you don't find a way to make money while you sleep, you're going to have to work until the day you die. So find a business, find an investment, get into something that you can make money while you're asleep, because otherwise you're going to have to work until the day you die. And that would be very, very sad. And the other thing that Warren Buffett said that I take it to heart is that, it is not your fault if you're born poor. But if you die poor, it is. Once again, it is not your fault to be born poor, but if you die poor, it is. So you have to start taking control of your finances. You have to take control of your life. You also have to understand how money works because I have a lot of clients. I've been doing accounting work for years and doing retirement planning for many of my clients for many, many years. So I have a lot of clients that make money, but very few of my clients know how the money works. Very few truly understand how money works. And those that do, they're tripling and quadrupling their investments because now they're using leverage to benefit between money moves that are being made any day. Everybody talks about the Federal Reserve and the Federal Reserve Bank. And by the way, I think of the Federal Reserve System as a cartel. It's a legal cartel, but nevertheless, it's still a cartel. And with this, I'll close. Always remember that, you hear the Federal Reserve Bank, but the bottom line is that it's not federal, it has no reserves, and it's not a bank. Now, how can you call something the Federal Reserve Bank when it's not federal, it has no reserves, and it's not a bank? And this is how governmental agencies and how the few want to control the many. And this is why you need to pay attention. Every dollar that you get into your economy. And last week I did another video. I did a podcast on opportunity cost and making the right decisions for you and your family with money. Because remember, money is scarce. There is scarcity with money. In other words, it's not an infinite amount that you're going to make in your lifetime. So you got to make it right. And with that, you have to not only have the ability to merge the economics of money and the personal decisions that you're going to be making in your personal economy and that of your family, and then you actually merge it with the politics and the politics of the day and what politicians are trying to do. Because if you don't control politicians, they're going to be controlling you and your family every single day. Now, as always, if you need to reach out to me, please feel free to give me a call at area code 305 304 4770. You can also send me an email at Bert, B-E-R-T, at bertsalazar.com, BERTSALAZAR.com. And always remember that my goal for you and for your family, like we do every week, is to kind of help you change the way that you see things. Because when you change the way that you see things, the things that you see change. So once again, thank you for giving me a few minutes of your time today, and I'll talk to you soon. Take care. Bye-bye.